Panacea, right? Panacea was at 20. But same pharma space. We'll come back with more stocks. I mean, it's not holding. Gains are being given back on the index level. Andrew Holland is with us. He's Market Master of the Day, Chief Executive Officer at Avendus Alternate Strategies. Andrew, great to have you with us here back on the show. Thank you very much.
Morning.
More downside or a little bit of a turn here in global markets and the markets here? What's your sense?
My sense is it's, I mean, globally it's looking very scary, Prashant. There's no other way I can put it. You know, the statements yesterday from the Bank of England, not just about the pension funds having 3 days to kind of get their act together, but the fact that they're kind of worried about the financial stability in the UK, it's really a telling moment. And I know the market's going to think, okay, at some point, you know, the Fed and central banks will have to, you know, kind of go on hold or, you know, help, you know, ease some of these worries. The problem is this: is if you think about the Bank of England as a company, like with a balance sheet, it's got huge amounts of debt. And its interest costs are rising, and the revenues are coming down because of global slowdown. So, you know, there's only a couple of ways they could really change this. Is that the government would have to rein in spending. You know, but given the recent budget they had, that's going to be a difficult task for them to do so. So you get into this stagflation problem and credibility. And I think that's what's the part that's worrying me is you know, you've seen it with a central bank saying there's problems out there. So what else is hidden under the carpet as we keep tightening? I think will come out from the corporate sector as well. So it's a financial problem I'm looking at now, Prashant. Not the fact that we all probably know that, you know, the global economy is going to go into recession in most countries. It's this financial problem which I'm really scared about.
But at the end of the day, in every situation, right, Andrew, good morning. In hindsight, these kind of global turmoils have always worked well for Indian investors. Buying that dip would have helped you make a lot of money. If you look at the last maybe 2, 3, even 10 years, do you think this time around is going to be different? And if not, then should one continue to buy the dip in the Indian market?
No, so you're right. I mean, I'm not buying into the kind of narrative that's going around that India's decoupled. But from an overall perspective, our prospects do look a lot brighter. So that you know, I'm not going away from that throughout all of this year. But you know, you can't run away from something which is financially could have an impact on global markets. And it's being played out through the currencies and bond markets at the moment. So at some point it will play through equities. I'm not saying that once that fall happens, it should be the time to get even more constructive on putting more money to work in the Indian market. But just at this point, it's like, you know, it just feels that you know, there's something, you know, the lull before the storm. Something's going to give here in global markets, and we've seen it anyway in terms of the you know, all you know, virtually all markets are in bear markets now. But I think the earnings revisions yet have to happen, and of course this unintended consequences, which we're starting to see in the UK of just tightening, and no one is anywhere near tackling inflation yet. And I think that's what we've got to kind of think about over the next 1 to 2 months. This is a time, if you say it's a pivotal time, but I think this is it. This is the moment that we'll be able to see how governments and central banks will have to come together at some point and try to resolve this problem, because it's getting a little bit out of hand, in my view.
So then, how does one, look at their portfolio in light of this? What should the asset allocation strategy be between equity, debt, cash, and gold? And at the same time, in equity itself, what are the sectors that you're backing? I mean, if one has to construct a fresh portfolio right now, how would you distribute the money?
So, I mean, I'm not a wealth manager, but I would have thought if you can lock in 7.5 or more, over the next 2 years, which is risk-free, that's obviously a good return to be thinking about. I think with equities, that's where you're going to get the bigger bang for your buck going forward. But I think, I've said before, when the market was falling, that anywhere nifty around 16,000 is a good entry point to start building. Now, listen, there'll be favorite stocks, favorite sectors within that which can still do well, even in that fall. But I think at this point, you're just really hiding in the kind of safety stocks, which have some pricing power to get relative performance, because our markets cannot withstand a global financial problem.
A few more names which were not in the mix earlier. So HCL Tech is still top of the charts. Varun Beverages is up 1.5%. It sold off yesterday. Aarti Industries is up 3%. So that's another one which is doing well. KRBL is coming up with 2% in gains. Liberty Shoes we pointed out. Marksons we pointed out. Marksons is up 9% now. So almost 51. Panacea Biotech was up 20% yesterday. It's up 1.5%. So slowly starting higher. And there's Aptech, which is up 4% as well. So just a bunch of more names on the upside that we are highlighting. Andrew, so just hiding in defensives, but what really is are defensives really? Because there is the currency risk as well, right?
Yeah, so I'd obviously be more domestic. I'd be looking at telecom and FMCG as the kind of pure kind of domestic safety havens at this point, and they do have some pricing power going forward. So those are the sectors I'd be hiding in if I wanted to get performance. I just think that
and the one area from where we've heard company after company sounding pretty pessimistic is the staples space, consumer staples. All right, FMCG pretty much. We had, for example, the Dabur update. We've heard from others as well. So how would you square that? You're saying that the two areas are the FMCG space and which was the other one? Telecom. But FMCG, how would you square the commentary coming in from managements?
Yeah, so I think what we're seeing there, Prashant, is that always you get as input prices start to fall, some of the companies will look to increase market share by reducing prices a little bit more aggressively than others, and then it'll stop. But at the end of the day, we're all still going to need to feed ourselves. So that's where the pricing power comes in. As the economy slows. And if you just take again, if you look at what happened in the UK, grocery inflation, if you go to your supermarket, is up 14%. So you will get that pricing power coming back. So it's really a more of a shorter term. We've had a margin hit, and now we're trying to take some market share, and then we'll start increasing prices again, or hold prices where they are. And obviously your costs will not be rising, your input costs will not be rising. And telecom, obviously, with the rollout of 5G, I think will add a lot of momentum for these stocks going forward.
Okay, by the way, the market is picking up pace. A small, a gradual pace, but pace nevertheless. And the space to be in this morning is specialty chemicals. So all your stocks, Aarti Industries, Naveen Fluorine, Deepak Nitrite, are all up anywhere between 2 to 3% odd. So I guess that green shirt worked at the end. I don't know whether it'll last through the course of the day, but we can hope for that, for the sake of the bulls.
Anuj was talking about divine intervention. We got the intervention right here.
Well, if it was only that, if it worked that way every single time, I wouldn't be sitting here. Right?
We'll try systematically.
Okay, but Andrew, what are your thoughts on autos? Because this time around, it's expected to be a pretty strong showing for them. Gross margins are expected to improve. Volumes are going to go up. Supply chain constraints have eased. There's channel filling before the festive season. Do you think the best of the auto stocks performance is yet to come? And if yes, what pockets do you like?
No, I think the auto sector remains a kind of favourite for the longer term. And when I say longer term, I mean over the next 1 year, because I think there's too many short term problems out there. And I think the obviously if we're going to a global slowdown, all the input prices for autos will start to will start to come down. And even though you're seeing that in Europe in terms of a downturn, because the order books are so long in terms of people waiting for the cars. Whilst it's having an impact on the used car market, people are coming back and buying and putting their orders back for new cars. So I think the prospects for the auto industry remain very good, and I think that the play will be really of who's going to be the winner in the EV market, and that's still a lot to to come through there. So I think some of the best plays would probably be in the auto component segment, which will benefit from anyway the growth in the traditional four-wheeler market as well as EVs going forward. So that's the way I would think about the auto. So you might see some corrections. It's been a good run for some of them, but I think the momentum remains.
Okay, Andrew, we'll leave it at that. Thanks a lot for joining in and have a great one. From autos, let's move to another vessel, shipping. The shipping industry